Imagine you spot a perfect point of interest on the higher time frame. You place your trade, and just before the market moves in your direction, it stops you out. A few days later, you find another setup. This time, it even has inducement, so you are more confident than before. You take the trade, but once again, the market moves against you. If this has happened to you, do not worry, it happens to every trader. But what if I told you the problem is not always your strategy? Most of the time, it is your entry. In this video, I will show you 2 confirmation entry models I use to grow small trading accounts. These models can help you avoid many unnecessary stop losses, improve your risk to reward, and get clean sniper entries like the one you are seeing on the screen right now. The first model is the one that many traders already know, but the second one is the one you should pay close attention to because I've not seen any trader talk about it. Once you understand it, you will start looking at your entries differently. So let us begin with the first one. Before we go into it, you only need to understand one thing: your higher time frame point of interest, also called a POI. This can be a fair value gap, an order block, support and resistance, key levels, or any area your strategy uses. For this video, I'll use demand and supply zones because that is the strategy I trade, but the same idea works with any strategy. Now here's where many traders make a costly mistake. They identify a higher time frame POI and enter the trade immediately. Sometimes that works, but many times the market pushes a little deeper, takes out their stop loss, and only then moves in the direction they expected. Instead of entering immediately, wait for confirmation. As price reaches your higher time frame POI, move down to lower time frame and watch how the market reacts. If the market was making higher highs and higher lows, then suddenly breaks that structure and start moving on the opposite direction. That is called market structure shifts, or MSS. Some traders also call it CHOCH, which stands for change of character. That shift tells you momentum is beginning to change. Now identify the lower time frame POI that causes the market structure shift. That will become your entry. At the same time, the lows that formed before price reached the higher time frame POI become liquidity. Those are the areas price is likely to target. So instead of entering from the higher time frame POI, look for the price to pull back to your lower time frame POI. Take the entry there and target the liquidity by taking partial profits along the way. Now that you understand the idea, let us see how it looks on a rate chart. This is AUD/NZD on a daily time frame. The first thing I notice is this strong bearish move. Just before that drop, we have a supply zone. Since I trade the minor supply, this becomes my higher time frame POI. If you use different strategy, simply replace it with your own point of interest. At this stage, I'm not looking for any entry. All I want is for price to come back to my higher time frame POI. Until that happens, there is nothing to do but wait. Now price has returned to the zone. This is where many traders jump into the trade immediately, but I still do not have confirmation. So instead of rushing in, I move down to the 4 hours time frame. Notice how price was moving in waves, creating higher highs and higher lows as it pushed into our higher time frame POI. Now watch what happens next. Price breaks the previous low. That is my market structure shift. It tells me buyers are beginning to lose control and sellers are stepping in, but I still do not enter yet. I now look for the move that caused the market structure shift. Here we have a strong bearish drop. The candles just before that move form my lower time frame supply zone, and that becomes my entry. Everything is now in place. We have our higher time frame POI, we have our confirmation, and we have our lower time frame POI for the entry. The lows that price created before reaching our higher time frame POI now becomes liquidity, which is where I expect price to move next. So I place my entry at the lower time frame supply zone and target the liquidity below, taking partial profits as the trade continues. Now let us see how the trade plays out. Price pulls back into the zone, gives us a clean sniper entry, and then drops straight into the liquidity exactly as planned. This is why I prefer waiting for confirmation instead of entering as soon as price reaches my higher time frame POI. Will this setup win every time? No strategy does, but it can help you avoid many low quality entries and give you much better risk to reward opportunity over time. Now, if you think this model is powerful, the next one takes it a step further. It adds one extra confirmation that can help you filter out even more bad trades. In my experience, it is one of the most overlooked entry models among retail traders. Now let us move to the second entry model. This is my favorite because it adds one extra layer of confirmation. It does not appear as often as the first one, but when it does, it can produce some really clean entries. Pay close attention to this part. This setup starts with a liquidity sweep. In simple terms, the market takes out the previous high before reversing. After that, price breaks the previous low, giving us our market structure shifts, MSS. Now we know momentum has changed. Next, identify the POI that caused the move. In my place, it is supply zone. But here's the detail most traders overlook. Just before the supply zone, there is another high resting very close to it. That high becomes the inducement. This is important because inducement often attracts price before the real move begins. Just like the first model, all of this must happen at a higher time frame POI. That higher time frame POI can be anything your strategy uses. For me, it is a supply zone. Now let's all see how this looked on one of my recent trades. This is AUD CHF on the weekly time frame. The first thing I do is mark my higher time frame POI. My plan is simple. Whenever price returns to this area, I will drop to a lower time frame and wait for confirmation. Now price has reached the zone. Again, I do not enter immediately. Instead, I move down to the lower time frame and let the market tell me what it wants to do. Price touches the higher time frame POI and reacts, but I still do not have confirmation. Then it happens. Price sweeps the previous high, taking the liquidity above it. Immediately after that, it breaks the previous low, giving me my market structure shift. Now I have everything I need. Here is my supply zone, and just below it, notice how close the inducement is. That is exactly what I want to see. I place my entry to cover the zone and set my targets at the next liquidity resting below. Now watch how the trade plays out. Price retraces into the zone, gives us a clean sniper entry, and then drops aggressively. This trade delivered almost 8 reward. Think about that for a second. If you normally target 2R on every trade, you would need almost 4 winning trades to make what this single setup produced. That is why I like this model so much. It is a high probability setup, but it will not form every day. The key is to stay patient and wait for the market to give you confirmation instead of forcing trades. If you found this video helpful, subscribe and turn on the notification bell so you do not miss the next one. Also check out my other trading videos. I'm sure you will learn something that can improve your trading. Thank you for watching. I will see you in the next video.